Hi, I'm Michael LeBlanc, Senior Portfolio Manager at LLC Private Wealth and CG Wealth Management, and this is Mike on Money. If you're looking for ways to generate more income from your investments, especially in sideways or modestly rising markets, this strategy might be worth exploring. Today, we're going to be talking about covered calls, a time-tested option strategy that can help boost income from your stock portfolios. Let's break it down on how it works, what the pros and cons are, and whether it could be a fit for you. A covered call is a strategy where you own a stock or an ETF and sell a call option on that same security. When you sell that call, you're giving someone else the right, not the obligation, to buy your stock from you at a specific price, what we call the strike price, by a specific date. In exchange, you collect a premium. That's your income. Let's say you own 100 shares of a stock trading at $50. You sell a 1-month call option with a $55 strike price and collect $1 per share in premium. That's $100 in income for the month. Whether the stock goes up or down or stays flat, if the stock stays below $55, the option expires worthless and you keep both the shares and the premium. If the stock rises above the $55, your shares will likely be called away. So you sell them at $55, locking in your gains plus that premium you collected. You can keep the income and buy back your shares to start the whole process over again. Here's why investors like covered calls. Generates consistent income in flat or mildly bullish markets, enhances total return, especially when dividend yields are low, lower volatility through cash flow, and improves portfolio discipline by encouraging sell targets. Of course, there's no free lunch. When you sell a call, you're giving up some upside potential. If your stock suddenly surges, your gain is capped at that strike price. You don't get to ride the rally all the way up. Also, if the stock drops significantly, you still hold the downside risk, just with a little bit of premium cushion. So it's not about predicting moves ups or down, it's about being paid to wait, or an exit strategy for your target price. This is why lower volatile stocks like banks and utilities are popular for these strategies. Covered calls can be great for retirees seeking more income in their portfolio, conservative investors looking to enhance their returns without taking on extra equity risk, investors who are neutral to slightly bullish on the stocks they hold. This strategy works especially well for choppy markets, when prices aren't soaring or crashing. You own quality stocks, sell call options above the current price, collect premium income, and you repeat consistently. To recap, you hold a stock you're comfortable owning, and you sell call options above the current price. You collect your income while capping some upside risk. You repeat the process for steady cash flow. It's a disciplined, income-focused approach that can complement a broader investment strategy. If you're curious whether covered calls could enhance your income or want help building a strategy tailored to your portfolio, I'd be happy to chat. As always, make sure any option strategies fits your risk tolerances, income needs, and overall goals. I'm Michael LeBlanc. This has been Mike on Money. Thank you for watching. Feel free to reach out anytime.